have Alka Anbarasu, Executive Director Rating at Moody's, now joining us. Alka, afternoon. Ashesha this side. Thanks so much for taking your time out and joining us here on ET Now. I was just going through your latest report on private credit market, and you have said that you are expecting sustained growth in private credit market going forward, especially for a country like India, where penetration is on the lower side. What kind of growth, what is the CAGR growth that you are penciling in for India's private credit market for the next 3 to 5 years?
Sure. Hi, Ashisha. Thanks for having me here. Yeah, we do think that India's private credit market is poised for growth. It doubled in the past 5 years, and we see the market further doubling over the next 4 to 5 years. By 2030, we expect the market size to exceed $50 billion. And this is largely driven by the structural financing needs of the country, be it infrastructure or even long tenor financing for the various growth segments that we see in the country. We also see that banks probably will not be able to meet all the funding needs that are out there, and hence there is greater demand for private credit in India as well.
Okay, so that's as far as the growth potential for India's private credit market is concerned. And you've stated about two specific sectors in your report. One is real estate and the other is infrastructure. But other than these two, which are the other sectors, in your opinion, that will drive faster growth for the consolidated private market to actually grow going forward?
So there are a few factors in India which have shifted over the past 4 to 5 years. First of all, the incremental growth in private credit is coming from more fundamental sectors, be it infrastructure, digital economy, but also from the wider corporate sector. And the private credit market is moving from what used to be a special situation or a distressed type of lending market, or like you said, real estate lending market, into more mainstream companies. We do think that this type of funding source, but in particular because it can meet the tenor requirement of borrowers as well, is likely to become more mainstream. We have seen greater use or greater demand for private credit from the infrastructure borrowers or in the digital economy as well. But broadly, we see this sector growing across the span of corporate credit in India.
Okay, and how important is GIFT City in attracting global private credit capital into India? And do you think that could actually move the needle for the sector's growth story over the next 5 years?
For now, large part of the growth is driven by domestic funds or alternate investment funds or AIFs in India. And these funds have channeled a fair bit of money, which is domestically sourced, but also international capital. Gift City is a clearly an enabler of bringing in more foreign funds into the country. Having said that, from a foreign investor's perspective, there are still two main concerns when it comes to investing in India. The first is the withholding taxes when they enter via the Gift City route, and the second is the hedging cost of the currency. Even if they are investing in dollars, but the hedging cost when it comes to the domestic rupee is still quite prohibitive. So those are the two factors having a bearing on the foreign funds appetite for India. But for now, we have seen that there's a large pool of funds available even domestically, and the AIFs are playing a significant role in channeling private funds into where the funds are needed.
Okay, so domestic funds continue to remain on the higher side, and perhaps global capital will not move the needle. That's the word coming in. But Alka, since you track the sector very, very closely, do you think the government can actually come up with some steps in order to insulate the sector further? Any regulatory changes that are required, in your opinion, to ensure that perhaps the growth is higher as compared to what it is projected right now?
From India's regulatory environment perspective, the insolvency code is a significant enabler for private funds to provide lending into the market. The insolvency and bankruptcy code has clearly shown that when companies go into trouble or they default, the fund providers or the lenders do have significant recourse to the company, and they can even take over those companies. And this is one enablement factor that is driving more appetite from private credit funds into the India's financing landscape. Perhaps in terms of regulatory environment, we talked about the gift city part where clearly there are some issues for foreign funds, and that's more comes from their risk appetite as well as from their own returns requirement. Having said that, from where we are in India in terms of the regulatory environment or also the economic environment, it's fairly conducive for corporate lending right now. So to that extent, I don't think the regulatory environment is a major impediment, but it's all about perhaps finding the funding needs as well as the where the funding needs to go and the returns need to match. Having said that, but there is ample demand in India right now for long term funding need.
Okay, ample demand for long-term funding and no major regulatory changes that are required. That's the word coming in. But Alka, if you track the listed universe, which listed Indian financial institution or alternative asset managers are best positioned to benefit from the structural trend in rising private credit market? If you can't name individual companies, some section of the market which will perhaps benefit as a result of rising private credit market?
So from I mean, yeah, I won't be commenting on any specific listed companies, but infrastructure is one sector where there is demand for long-term financing, and we do see that banks don't have a lot of appetite for long-term lending. This is an area which private credit providers are coming and fulfilling the gap. So whether it is the large infrastructure, whether it's airports or other types of infrastructure, clearly there is a huge funding need, and banks will also play a role. But there is ample need for other types of funding providers as well. The digital infrastructure, whether it's data centers or other kinds of AI related infrastructure, is also leading to significant demand for long term funding needs. And these are the main sectors where we do see private credit moving beyond perhaps what used to be special situation type of lending, but into more mainstream, high quality type of borrower lending. At the same time, the demand from real estate remains strong, and this is one sector again where banks have some regulatory restrictions in terms of, say, lending for land bank acquisition, or even the non-bank finance companies or NBFCs are quite shy of lending to real estate developers, particularly for land bank acquisition. And we have seen that private credit providers are have played a material role in this type of lending as well. So from a if you ask me about specific when it comes to large corporates, it's really the infrastructure sector where we do see significant funding needs, where private credit can also play a role.
Okay, so private credit can play a role for infrastructure, especially real estate. That's the word coming in. Alka, thank you so much for taking your time out and joining us here on ET Now and sharing your thoughts on the private credit market and what the structural story could actually look like for the sector going forward. Thank you for taking your time out and joining us here today.
Thank you.